Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. And our guest for this week's show is commercial real estate investment expert Ash Patel. Now, Ash has been a full time commercial real estate investor for over 10 years. He's a value add investor, and his experience really runs the gamut, all the way from retail to warehouse, office, industrial, land, mixed use, medical, and restaurants, just to name a few. From vacant buildings to net lease properties, the consistent theme is extraordinary high returns. He is a hands-on property manager, has never used a property management company. So, guys, I'm excited to get onto the show with Ash. But before we do, just have a few quick housekeeping items. First off, here, I want to remind you of how to get a free copy of my recently released best-selling book, The Cash Flow Investor: How to Create Financial Freedom Investing in Commercial Real Estate. You can either go buy a copy on Amazon for $20. All profits do go to charities near and dear to my heart, so it definitely goes to good use there. Buying a copy on Amazon, but for those that want to maybe save a few bucks, I've made a copy for free just to my loyal tribe of listeners here. You can go over to kevinbupp.com/free book. Again, kevinbupp.com/free book. Moving on here, I always get emails asking about what's going on over at Sunrise Capital Investors. Well, we're still doing deals. I don't just do this podcast, that we actually do deals as well. We're real estate investors just like Ash is. And, our pipeline's interesting. Over the last couple months, it's really kicked up quite a notch. And so just got back from a due diligence trip a few weeks ago in Washington, D.C. on a Class A parking asset that we're taking down, and got a number of other deals, mobile home parks and parking assets in contract, the majority being direct to owner off market, like we love to do. And roughly about $60 million worth of deal flow at present time. So if you guys want to learn more about any offerings that we have currently available, you can go over to investwithsunrise.com. Again, that's investwithsunrise.com. There you can see both information on our parking and mobile home park opportunities, as well as a more recent offering that we put out, which is a build to rent fund that's happening in Phoenix, Arizona. We've got a number of projects happening in amazing urban info locations in Phoenix. And again, go over to investwithsunrise.com to learn about everything that we've got going on and to see how to partner with us. And now with that, guys, I'd like to welcome my guest for today's show, Ash Patel. Ash, how's it going, my friend?
Kevin, very well. How are you? Excited to be here.
Yeah, buddy, I'm doing awesome. As we were talking about, you just interviewed me a few weeks back, and so now it's my turn to turn the tables on you. So excited to have you here, and excited to really dive into it. I had you on a few years back, but lots have changed since I had you on the show last. So again, just excited to get up to speed with what you have going on today. And so with that, Ash, I'd say for those that aren't familiar with you, who you are, your story, maybe take a few moments and, tell us a little more about yourself and what it is you do.
Yeah, Kevin, I spent probably 15 years in the corporate world. I was an IT manager, did the grind for a lot of years. It was one of those things where I always knew that this wasn't my calling, always had a side hustle, but it was one of those things, man, where it was comfortable being there, right? Nice salary, hard to leave all of that behind and go off on my own. And all these side businesses that I had, some worked, some didn't. It wasn't until I found commercial real estate that I found my true calling very quickly, left everything behind, became a full-time commercial real estate investor. And, one of my first properties was a mixed use building. So I was able to see both the commercial side of things and the residential side of real estate, and quickly found out that commercial tenants improve your property and residential tenants add wear and tear to it. So became a full-time commercial real estate investor, asset agnostic. So I don't care if it's land, medical, warehouse, industrial, retail, as long as I can make very high returns, I'm in.
Okay, fantastic. I appreciate that. And, my first question, the first thing that comes to mind, Ash, is, I always preach, kind of, find the lane and then stick to that lane until you can become an expert in that particular niche or space. And that's just my opinion, right? So like, there's no right or wrong there, but, speaking to asset agnostic, that paints a pretty wide brush. And so talk to me about gaining expertise or just really understanding how to identify an opportunity and actually capitalize on that opportunity when we're talking about, again, when we're speaking to running the gamut of asset classes. Again, in the beginning there, I said restaurants, I said industrial, I said medical office, multifamily, mixed use, industrial. I mean, there's a lot there. So, how do you gain expertise in that wide variety?
Yeah, and I'll throw another curveball. I also invest in startups, so other businesses as well. But sticking with real estate, um, that's a good question, but it's all the same formula. You
Mhm.
have a piece of property that you want it leased out, whether it's multifamily or a restaurant, finding a tenant, evaluating maybe how much money to put into the asset, what your potential returns are. The more you do it, the better you get. In the beginning, I would spend hours underwriting deals. And today I could thumb through 100 listings in a few minutes and figure out which ones deserve a deeper dive and keep refining that process. So it really just comes down to basic math. And I wish more people would look at other asset classes because, take the blinders off, man. Just because you're great at multifamily, don't turn down that warehouse deal. Dive into the numbers and see what the potential returns could be. Find a mentor, find somebody to help you underwrite it, and it might be a great asset to add to your portfolio.
Now,
But
are you?
it's basic P&Ls.
Yeah, no, no, I appreciate that. And are you mostly investing in your local market area, or do you have a wide reach?
I started out locally and then just started going in larger concentric circles. And now it's deals east of the Mississippi. For whatever reason, we've never done anything out west. But as far south as Texas, Atlanta, Florida, it really doesn't matter where the asset is.
Okay. Case studies always help paint a picture, and provide an example of what's a real deal look like in the life of Ash Patel. So, do you have maybe a recent deal that you took down, or maybe one you're working on at present time? What is it? What asset class? What market it's located in? What's the opportunity that you see at hand, and how do you intend on executing on that opportunity?
I'll give you two examples. So, over the years, I've mentored a lot of people as well. And my sister in law, who was in the restaurant industry for a lot of years, worked at the corporate level, has her own successful franchises. Sorry, has her own successful restaurants that she franchises out.
Mhm.
Post COVID, she ended up having to go back to work as a line cook because she couldn't find enough people to work. So she came to me and said, Ash, I've got to learn commercial real estate. These restaurants are killing me. So I started teaching her how to find good commercial deals. First property she found was a flex space building, which is basically a combination of warehouse and or retail office, whatever it may be. But most flex buildings have bay doors in the back, whether they're loading dock height or they're drive-in doors. And this was a property that had 2 units vacant and 2 units occupied. Purchase price was $430,000. They were on gross leases. We ended up purchasing this together. This was in Paulding County, Georgia, and we filled the two vacancies, but neither one of us knew that area very well. So we started marketing it while we were in due diligence. And we figured if we couldn't get good traction, we would walk away from the deal. And honestly, I think it was a couple Craigslist ads and a Home Depot for rent sign posted at the front of the property, started getting a ton of calls. So we knew that we would be able to fill the vacancies. Didn't exactly know what price they would be filled at, but now we're 6 months into the deal, fully leased. All the tenants are on triple net leases, and the property's worth $950,000 at the same 8% cap rate that we entered at.
That's
In addition to
fantastic.
that, another strip mall that was mostly vacant for 5 years, and I don't understand why. I think the owner just had numerous properties, and this is like the stepchild that they didn't want to deal with. So, $2.5 million purchase. We went in there, filled the vacancies. There was a church occupying 6,000 square feet of prime Class A retail space, and at the end of the year, the church's lease was up. They did not want to renew. We found additional tenants to fill that 6,000 square foot space. So, valuation on that deal went from 2.5 million to $5 million.
Great. Now, fantastic. I appreciate you sharing those with us. Now, using the getting to the retail deal, was that in a market that you were familiar with? Because you'd mentioned that the majority of being vacant for had been vacant for quite a number of years. Was that a market that you knew intimately,
No,
or okay?
we kind of roll the dice, but there's some factors that you look at. Surrounding areas had already experienced growth. There was a supermarket anchored strip mall walking distance from the location. There was a Sherwin-Williams right down the road. And whenever you see a McDonald's, a Sherwin-Williams, you know that the traffic counts have already been studied, and you know that the household income is there. And it helps you with your due diligence.
Hmm.
When there's other, grocery anchored strips there, all these other people have already done their homework. Kevin, similar to if you see a corner where there's a Walgreens, a CVS, and a Chipotle, and if that remaining corner is available, take it. Right. So let the other tenants, let the other franchises do a lot of that legwork for you and just ride that wave.
Yeah, no, I agree with you. Again, they've got they've got dedicated departments within their organizations that spend tens of millions of dollars a year studying where the most ideal location is for them to put a new location or new branch or what have you. And definitely can piggyback on the back of those giants. Speaking to again to this retail deal, I've always been told, and maybe you can discredit this, but I've always been told that churches don't make for great anchor tenants in a retail strip plaza. Is that the case?
They're fillers typically
Mm-hmm.
because they don't pay a lot of money, right?
Mm-hmm.
However, the benefit is a lot of times they're only occupied Sunday mornings. So if you have a strip mall that doesn't have adequate parking and you can't put another high traffic lunch restaurant or dinner restaurant there, and you really want to fill some vacancies, churches are great because a lot of other businesses are slow or closed. Flex space is ideal for churches. Now, again, most flex spaces look like the inside of a dirty garage when you first get them, right? They can be reconfigured as machine shops. HVAC contractors can use that as their home base in the morning. A lot of different uses. But in the past, we've given those locations to churches, and they will go in, they'll put LVP flooring in, they'll redo the bathrooms, they'll paint the walls, nice, fixtures, light fixtures, and they really improve your space. So while retail is not the ideal place for them, if you have an office building, if you have a flex space building, even larger warehouses can all be used for churches.
Mm-hmm. So, as far as financing is concerned, again, you've got a little bit of a wide reach now, asset agnostic. That could, pose a challenge in some instances with getting a bank or a lender comfortable, given that maybe you're new to that marketplace. Speaking to the retail deal, the majority of it being vacant, there's not a lot of in place revenues, and so how do you overcome that hurdle?
That's a great question. And that's where commercial really differs than multifamily or other asset classes. For us, our lenders are partners. They're not commodities. We don't use brokers in our business. I know a lot of multifamily people have great results using brokers because they get great rates, great terms. However, that broker is a commodity because there's a secondary market for multifamily or residential loans. For commercial deals, there's often not a secondary market. Whichever lender initiates that loan typically holds it on their books for the life of the loan. So it's really important that we build a partnership with our lenders. When you're going into a new market, you want to sell yourself, you want to sell your track record, and you want to sell the deal. You never just fill out a loan app and give them all the due diligence materials. You go in there with a narrative. You get to know the loan person, you get to know the process of approvals. So if it's the board that has to approve the loan, if it's the bank president, you want to try to get in front of a lot of those people. If it's remote, do it by phone. And you want to build that partnership with them. And again, you've got to sell everything yourself, your track record, the deal. You go in there. We typically go in with a one-page narrative about the deal, what our turnaround plan is, and why we love it so much. If it's a completely new lender, we send them a bio of ourselves and or of our team, and we let them know that this isn't our first rodeo. Here's what we've done in the past similar to the deal that you're looking at, and here's our turnaround plan. So it's a lot of marketing towards lenders.
Yeah, I know a lot of these smaller portfolio lenders. A lot of them, they either want the asset, local to them in their market, or the borrower, or both. Have you run into the same thing?
Almost every time,
Yeah.
except if you build a rapport with a lender that is a little bit larger than just a local lender. And
Hmm.
again, we prefer the smaller the size, the better. Somebody that's got 1 to 3 locations is ideal if you're buying something in their backyard. But once you're established with a lender, they'll typically finance deals that are out of state for you, as
Hmm.
long as they're legit deals, right? If you're buying fully vacant, stretching your budget, it might be a tough deal to close on. That's where you're going to want to find a lender local to the asset.
Hmm. Yep. No, I agree with you. Talk to me about, some of the volatility that we're seeing, more specific to rates at this point in time. How are you guys kind of dealing with the ever increasing rates, as it relates to new acquisitions, or maybe even deals that you currently own today that maybe are coming up on on a rate reset or a balloon where you need to put new debt in place. How are you handling that?
Again, great question. So, a lot of our loans are 10-year locks, 25-year amortizations.
Hmm.
And this is one of those rare times where our loans are cheaper than multifamily loans. Normally, you people, I'll say that term, you people have better rates, better terms. But right now, maybe because it's portfolio loans, our rates are around 5.25, 5.5. A lot of multifamily loans are much higher than that. So they're not really affecting our buying a whole lot, other than we're pricing in exit cap rates that are much higher than what our entry cap rates are. And that's something that a lot of the listeners really, I want to stress that to them, that when you're looking at your pro formas, understand that that arrow may not always go up and to the right. You've got to stress test your deals, right? Anticipate rates a little bit higher than what you're going in at. Anticipate your cap rates maybe 100 or 200 basis points higher upon your exit than what your entrance is. So we're very conservative with our deals. We turn down a ton of deals that other people pick up. And yeah, I mean, we're conservative. I'm 47 years old, so I've lived through the dot-com bubble, the housing crash of 2008, and I've seen what hard times can do to the economy. Whereas today, Kevin, anybody under the age of 33 has really only seen a prosperous economy.
Mhm. Yeah, no, I agree with that, and time will tell what these coming years bring our way. But inevitably, it's definitely, as we can see the rates going up, we know that things are being shaken up a little bit, and ultimately, I think there'll probably be some opportunity that comes our way as well. And so, I want to talk about that. Finding opportunities, right? Like you cast a really wide net. What's kind of your go-to method of actually finding deals?
It's finding mismarketed or mismanaged deals, or looking where no one else looks.
Speak to
So
mismarketed. I want to hit on that one. I think I know what you mean there, but go ahead and speak to that
yeah,
method.
two great examples of mismarketed. One is residential realtors posting commercial deals, and we've gotten some incredible deals that were priced 60 cents on the dollar because the realtor didn't know how to price commercial assets. They
Hmm.
use comps instead of NOI and cap rate. Another example of that is commercial brokers that don't do a good job marketing. We picked up a $5 million strip mall from two second generation commercial brokers who only posted the deal on their own website. And it's a mom and pop website, right? It's not like LoopNet or Crexy.
Yep.
And it's just one of those sites that we continuously scour, and we saw the deal on there. I knew the broker, so he ended up taking my call. And when I told him I want to put an offer in, he said, Ash, we've had so many people calling, wanting to put offers in. We just don't have time to return phone calls.
Oh my
And I'm
gosh.
like, oh my God, please don't return any. Like, let's get this deal done. So that's a great example of mismarketed deals.
Oh,
Mismanaged. Go ahead.
no, I was going to ask you, is there a method? I know that most MLS systems throughout the country, they kind of have their own little commercial division. But obviously, like if you're not a licensed agent or broker, you don't have access to the MLS system, you'd have to kind of use a broker and agent as a conduit. Is there any free system that's on a national scale that allows folks, I know realtor.com, that's just all the residential piece of it, but that's kind of the national database. Is there a commercial, MLS resource or database that one can access?
For commercial, there's obviously LoopNet, Crexy,
Right.
and several others. But
But the
I think
MLS piece of it, like the actual MLS commercial division, not
yes,
LoopNet or Crexy, but like the actual MLS commercial. I don't know what you want to call it, but
yeah, I got you. I
okay.
got you on this one. So I don't believe there is, and I'm not a broker or a realtor, never have been. So what we do is we find those local or regional realty companies that allow you to search by commercial. And when we find one of those, we bookmark it and just check back often. So
You
in
mean like their
different,
website? Like they've actually
yes,
got like, okay, got it.
yeah, in different markets, there's different realty companies, and usually there's smaller companies, and they will allow you to search the MLS for commercial deals. And this is typically residential realtors that are putting up commercial deals. So it's just finding all of the smaller regional
Got it.
local websites.
That makes sense. Okay, I appreciate that. So I interrupted you. You're going to go into mismanaged.
Yeah, mismanaged is finding deals that at first, a lot of people may turn down because it's advertised at a 6.5 cap. And when you dive into it, you realize that maybe it's not a 6.5 cap, their numbers are wrong, or the property has undervalued leases, or it has vacancies because it has an absentee owner, or the property manager is asleep at the wheel. So
Hmm.
diving into deals that a lot of people may otherwise look over has gotten us a lot of deals as well. So get the story behind the deal. I stalk the seller. I want to find out everything about them. How much real estate do they own? Are they actively involved in the business? Where do they live? What have they done to improve the center or office building or whatever it is over the years? And I really try to put together the whole story so we know what our potential upsides are.
Got it. Are there any asset classes that you're staying away from at present time?
Yeah, I don't do any multifamily unless I do it passively in other people's deals.
Hmm.
And same with self storage, RV, mobile home parks. There's people like you that do it way better than I could. And I have no competitive advantage against you. So
Hmm.
I don't want to compete against you. I'd rather compete in areas where there's a lot less competition. And because, commercial real estate, and when I say commercial, I mean non residential commercial,
Hmm.
a lot of people think it's too expensive or too hard. There's just a learning curve to it, like any other asset class. However, I think the learning curve with commercial deals is a lot higher. Every lease that we look at can have different nuances, different carve outs, out clauses that you have to underwrite. And because of that, I think a lot of people think it's just beyond their ability to take down those deals.
Hmm.
So, yes, I stick to those asset classes that just don't have a lot of competition. Self storage, there's giant companies out there that have incredible data and systems at their hands. They can find the deals better and faster than I can. They can manage them way better than somebody with no experience. So, I have no competitive advantage in those areas.
What's your sentiment on office, your traditional office as we know it?
Yeah, I don't know if this is the popular view or not, but I think people are going back to work.
Hmm.
They're going back to the office. And I think the next time we have a downturn in the economy, employers will again have the upper hand. Right now, people coming out of college or even people that were already in the workforce, if they go up to an interview, they can demand that they work from home or they can demand that they want a 4
Mhm.
day work week. And employers don't have a lot of options because of the lack of supply in terms of employees. The next time we enter a recession and those tides shift, I think you'll see employers saying, guess what? We're back in the office, we're back to work. And we're already seeing that with Wall Street banks. We're
Mhm.
seeing that with tech companies. They're demanding people are back in the office. Now, granted, they're doing it with a very gentle hand, right? We would prefer you be back in the office. Hey, let's start transitioning back to the office. But man, when those tides change, I think it's if you want to work here, you're back in the office.
Yeah.
So, right now, suburban office is absolutely on fire.
Mhm.
If you can find any kind of office asset in a walkable town where there's not a lot of competition, buy it. They're so easy to rent. There's so much demand for that because, Kevin, a lot of people that have been working for home for some time realize, when the kids are home from school in the summer, I can't work here. Or if you have both husband and wife working from home, there's only one dining table. Like, who gets it that day, right? People are realizing that they need to be in an office. There's got to be structure. Or if it comes time to hire an assistant, I mean, you want to be in an office. Now, the Class A office, where we have millions of square feet of vacancy, I think if you can pick those up for 30, 40 cents a dollar, you'll have a huge win. And you're seeing a lot of those starting to go to auction. A lot of those are being foreclosed on. In office, they usually sign 5, 10 year deals,
Mhm.
and those are starting to come up, and landlords are feeling a lot of pain.
I'm wondering how banks are kind of handling potential debt debt on office acquisitions if they're shying away from it. We have not bought an office, so I do not know the answer to that. But maybe you do. The different banks that you work with, what's their sentiment amongst offices and actually lending on office properties?
Suburban office, they have no problem
Okay.
whatsoever. Class A office, again, if you can get it for pennies on the dollar, you can afford to lease it at 30, 40 cents versus everyone else, right? So if you're amongst the sea of millions of square feet in giant office parks, you're competing with everybody. But if your rental rates are half of what the competition is, you'll fill up first. In terms of how lenders are dealing with their existing toxic office assets, they're ending up going to foreclosure.
Mm-hmm.
And you're
Got it.
seeing a lot of that.
How about the future of malls? I know you like retail, but that's a different animal. Talk to me about the future of malls and your thoughts there.
Man, that's a great question. What do you call the youngest generation that's like in their 20s right now? Is that Gen Z?
The Gen Zs.
So apparently Gen Zs love malls.
Hmm.
Millennials don't. Us Gen Xers, not really anymore. We kind of dread it. But I don't know if that's enough to save malls. I think you're just going to see a lot of redevelopment, whether it's
Yeah.
converting them to warehouse. There've been attempts at converting malls to live, work, play,
Yeah.
and man, that's tough, very expensive, and if it doesn't hit right, you
That's
just
it.
lost a lot of money.
Yeah. Yeah.
It's been done right a very, very few times.
Mm-hmm. Yeah, no, I agree with you, and I can't even reference one that was done right, but I have read a number of instances where that was going to be the business plan. So, with all that being said, Ash, for those that want to learn more about you and your business and what you have going on, I know that and I forgot to even mention that that you host the podcast as well, and so maybe go ahead and give yourself a few plugs as far as how to find you and how to follow you on with your podcast and anything else that you have happening.
So the podcast is the best ever show, and it's Joe Fairless's podcast. I'm just one of the hosts, and I
Hmm.
love doing it. Love learning from a lot of people. I am launching a new venture called Invest Beyond Multifamily, and I also have a commercial mastermind that's currently full. Every 6 months, I open it up to 20 students. We just filled our quota for this 6 month period. So it's me teaching mostly multifamily investors how to transition into commercial. Excuse me. You could find me on Facebook, Bigger Pockets, LinkedIn, Ash Patel, Cincinnati. Pretty easy to find.
Gotcha, gotcha. Good deal. Well, Ash, it's always good catching up with you, my friend. I appreciate you coming on and sharing your story. And guys, I'll be sure to put all that info that he shared in the show notes.
Awesome, Kevin. Always great seeing you. And congratulations on all of your continued success.
Thank you, my friend. I appreciate it. And guys, that's all we have for this week's show. And so until we meet again next week, this is your host, Kevin Up, wishing you huge success. Take care.